Hi everyone, this is Bag It On. It is Thursday, November 11th at 3 p.m. I wanted to give you and everyone an update to a collection of option trades that we put on Monday. And you can see them up above. I want to take a moment, explain and review again why we chose the options that we did, how we put them on, what they have done, and what we're going to do with them now. And we put these options on without any regard to a chart. No need to even look at a chart. So let me first review. What we did was we came to this tool right here called the SMC Trade Generator Pebble Beach Triggers. The SMC Trade Generator for Pebble Beach has a number of ways to be able to use this tool. You can use this first for stocks to buy and sell. You can use it intraday. You can use it daily, weekly, monthly as an investment tool. You can use it for futures, intraday as well. You can use the trigger mechanism over here to generate significant counter trends that could, in some instances, be the start of a new trend. Gives you your entry price, gives a calculation of the purse. This calculation is based on a $10,000 trade down to one share. This part of the tool, from here to here, from panic through fear to the mean, we call the trend axis, through greed to euphoria, can be traded in and of itself. Kind of shows you where you be. I'm going to do some drawing on this, so bear with me, at least I hope to. Now, the trades that we put on, let me see if I can get the right tool here. The trades that we put on Monday were all puts, and they were simple puts, one leg. And I'll explain in a moment. They were not vertical spreads. They could have been. And bear with me. So, but I want to highlight here is this tool right here. Maybe I could have used a different color, but we go from panic to euphoria, and then we have the trend axis down the middle, and that is the mean. Now, one of the things that we know statistically, no matter what the symbol is over here, and no matter what the time frame, which this time frame is a daily. Let me slide the cursor over. It's a daily. So I'm going to put this back though. I'm going to try to put it, oh, for heaven's sakes, put it back to there's my drawing. What we know is this. When price is up in here, the likelihood over the next 20 days that price moves back toward the trend is some 95%. Not 100, but 95% likelihood that it pulls back toward the mean. It may go underneath the mean, but it's going to at least pull back toward the mean. Now, there's going to be 5% of those cases where it doesn't and it keeps going. So there's no guarantees. On this side, the panic column, when price shows up in here, the likelihood is that price is going to move back toward the mean in the next 20 days to the likelihood of some 95%. So what does one do with that? Well, if you know some simple things about options, you can begin to diversify your trading techniques. We talk about diversification in terms of trading different techniques. So we're trying to illustrate some very basic option work in using this particular tool. And so what I'm going to do is go to a vacant or an empty space, and I want to describe what we did here. So I'm going to get my little drawing tool again. Bear with me. And if we have a continuum, like so, if we have that, the that same trend axis here. If we're out here in euphoria, and I think price is going to move back this way, see if I can get an arrow. I think it's going to move this way, back toward the mean. What might I do over here? What I might do is what we did do with just about all of these, was to buy a put. And I'll go ahead and see if I can. We buy a put, and it cost us so much money. If price moves, and I bought the put in excess of 20 days, approximately 25 days, and we'll show you those exact positions and how much money that all was. But what has to happen in order for that put to make money is the price needs to move back toward the mean, which is exactly what's happened with Booking, EOG, Goldman Sachs just a little bit, and BIB hasn't done much. And then Lam Research has actually defied the probabilities and has gone a little bit higher, and therefore my put has lost value. I've lost value in time, and the price direction has continued outward. It's become even more euphoric. Now, we chose to do a put on these 5 markets out here on Monday, namely because all 5 of them were out here. Some were also giving us what we call a Pebble Beach trigger, a reversal signal. And the markets themselves were extremely euphoric. So it was kind of a double banger. We have stocks that are euphoric. We have the markets that are euphoric. I want to come in and bet on the dark side, the probabilities that we're going to pull in, and I'll make money. Now, I bought the put. The amount of money that it took to buy one put here, I think one, and I think there were 5 here, was $20,000. And you might say that's a lot of money. It is a lot of money. But when you think about what one uses in margin or leverage for a NASDAQ futures to go overnight is some 17,000. So it's really, it's somewhat comparable. I could have reduced my cost by selling a put over here. If I had sold the put over here, I would have received a bit of a credit, and if the price, continues to fall, I wouldn't profit. But I could have reduced that cost of all these puts to some, probably down to about 15,000. But I didn't do that. If I was bullish the market, if the market's like next week, and we'll do this again next week, but if the markets are extremely oversold, I could come in and get stocks that are being panic sold, and I could do what? I'll do this in green. I could buy, I thought it was going to be green. I could buy a call. Now, I didn't do that, but I could buy a call. And they would cost me probably a little bit less money. The puts are always a little bit more because fear is a greater motivator than greed. But I could buy a call, which is a bet that the prices are going to go high. And if I wanted to offset the debit of paying for those calls, I could come over here and sell a call to offset that cost. So one can over here buy a put, betting on the downside. Over here, I won't take the time to write it out, buy a call, betting on the upside. And if you want to reduce your cost, you can do what is called a vertical spread. Buy the put, sell a put, buy a call, sell a call. When you buy, you're getting debited, and when you sell, you get a bit of a credit, and it reduces your cost. But here, all we did was to buy puts on these markets. So let's clear that. Let's go back to the tool that we used, which was this tool, and let's look at each one of these and see where in fact it is, and if we want to continue to hold these, because time is decaying and I really don't want to hold them too long. I only had about 20 to 25 days. It's only been 4 days. But so I come here and I look at BIB. Now, when we did it, BIB was up in here. It's here, and I'm down about 200. So I'm going to want to close that. I won't close it yet, but I will want to. Let's look at Booking. Here is Booking.com. Booking.com is in here, right in here. It's right back to the trend axis, which is amazing because when we bought the put, it was out here in euphoria. So it did beautifully. I bought the put, it moved back here, and here we are, $6,500. That, we'll talk about how much those puts were in a moment, but I'm going to want to close that too. EOG, because I've gotten my move. EOG, let's come down. I don't mean to make anybody dizzy. EOG, where is EOG? EOG is at 70, making its move back to the mean. You know, it's probably going to make a little bit more money, but I'm inclined. It's Thursday. You know, I put at risk a $20,000 leveraged amount. I'm for cleaning it off, and we'll regroup and do it again next week. And maybe we do a mixture. Maybe we do some put spreads. Would have been more, maybe a little bit. It would have been better. And maybe mix in a couple of call spreads. And we'll look to get on about 5 positions. And we'll use somewhere between $10,000 and $20,000 of leveraged money to do that. Thereabouts. But I'm inclined to close it. And then Goldman Sachs, we actually put Goldman Sachs on, I think it was Tuesday, but also Goldman Sachs was up here. It has moved down, and we haven't really done much in the way of price destruction. We would have wanted to do better, so I'm going to want to close that too. And then the one that's hurting us is Lam Research, and let's go look and see. Now, Lam Research has to be still in euphoria but let's go look. Here it is. Well, it was up in here, and it's still up in there, and it's put us down. We've lost time. The time has decayed, and that's what's put us down. So here are the positions. Here they are. This is BIB. The amount of the trade was $1,000. I'm down 170. Booking. The amount of the trade was $82.40. It was an expensive put, but it's up almost $6,700. Thank you very much. EOG was $930, was the cost of the put. It was all cost. I didn't receive any credit because I didn't sell a put. Would have been cheaper if I had. $190. Goldman Sachs was $1180. I'm basically flat. And then Lam Research is actually down. I spent $89.75. And I'm down $2,100. The cost of all these puts was $20,385. Now, it could have gone the other way. If I hold them much longer, I'm going to begin to lose time. So I'm going to close them all, and my net will be how much? My net will be $4,500. And they're all gone. We had 5 puts that we put on, 4 on Monday, 1 on Tuesday. Today is Thursday. The tool that we used was the SMC Trade Generator. We had a couple that showed a trigger here. We primarily pushed off of this tool, which we love, and our net is approximately $4,500. And we'll do it again next week. If you like this approach and you like this tool in particular or tools like it, you might want to visit stockmarketcaddy.com. And if you're interested in getting these tools on your desktop, you might want to give us a shout at 813-758-8263. Thanks.